So, service firms for 2014. So, I'm just going to remind you first of the layout and the similarities with club accounts. So, we start off with statement of reserves, they've called it, or statement of capital, you could call it. It's like the accumulated fund. Add up the opening assets and liabilities. Then you're going to have the shop profit and loss. So we have sales, purchases, etc. I have a section here for shop expenses because there could be some of the expenses that are specifically to do with the shop. So, for example, we might have wages just for somebody in the shop or rent for the shop to get the overall net profit, and that net profit is going to be one of the first income in the profit and loss account. So profit and loss, just like what we would have done with income expenditure account. Add up your incomes, take away your expenditures, and what's left is your profit. And then your balance sheet should follow the same format. The reserves that you've calculated from the first document, or the capital from the first document, that goes into finance by, and then we'll add on whatever profit we've made. So that's basically the introduction to it. Same as we would have done before. We start by looking at the top of the question and we start putting the numbers in. So buildings and grounds. So 620. Equipment is 70. Vehicles at cost is 90. Shop stock is 34. Stock of heating oil is 19. Creditors is 1600. 5% investments is 40,000. Contract cleaning prepaid 400, so that's money that we have prepaid, so that's an asset of ours. Clients' deposits paid in advance, so that's a prepaid income, so that would be a liability. Authorized capital is 600,000, so I'll include that here with this. And sorry, now the authorized is 600, the issue is 450, so the relevant figure I need to be putting in there is 450. So when I go to do my balance sheet, I might as well put that in there now and explain it. So we'll have capital, we have authorized, and we have issued. Same as you would have had in a final accounts question. So 600,000 is the authorized, the issued is 450. The 600 is only there for information. We're not going to actually include that in our maths at all. It's just giving information. So it says that all fixed assets here have 3 years accumulated depreciation. So I'm going to say that I'll have depreciation, or I'll call it accumulated on buildings. Vehicles and equipment. Okay, and they have 3 years accumulated depreciation already. So the depreciation for buildings is 2% of cost for a full year. Now I need to just check. It says buildings and grounds, so the grounds are not going to be depreciated. So a quick look here. We revalued our buildings. It doesn't mention anything so far. We may come up later on the question, but so far I don't see anything. So I'm going to assume that we're going to depreciate all of the 620,000. So it'll be 620 times 6%, because it's 2% a year, so therefore it's 6% in total. Equipment is 10% of cost for the full year. So we have 3 years, so whatever the equipment figure is, so 70 grand, we're going to multiply that by 30% because it's 3 years involved, and accumulated depreciation of vehicles. From date of purchase, date of sale. So 1st of 7, the vehicle cost 40, was trading against new vehicle, allowance was given for the old vehicle. So I need to deal with my disposal first. So we have the vehicles account. We have the accumulated depreciation. Okay, and now, so the vehicles started off as, where are we now? So vehicles is 90. And then we lost a vehicle that costs 40. So take away 40, and we'll add in a new one that costs 59. So that means that our vehicles is 109. Sorry, 109. Just double check. So 19 added on to 90. Yep, that's correct. So the accumulated depreciation. So at the beginning of this year, before this happened, we would have had 2 years depreciation. So the accumulated depreciation would be vehicles 20% of cost. So 20% of 90 would be 18. By 2 years is 36. So 36 grand minus the depreciation on what I disposed of, and then plus the depreciation expense. So the disposal. So when did I get rid of it? So we know that the vehicle originally cost 40. We multiply that by 20% and multiply it by how many years? On the 1st of 7th, a new vehicle would cost 40 grand on the 1st of the 1st 2010. So that means I would have had it for all of 2010, 2011, 2012, and 6 months of 2013. So that would be 3.5 years. So it's 40 grand times 20% times 3.5 years. So 28. So it's 36 minus 28. And then plus my depreciation expense for this year. So depreciation expense for this year, we'll do it the way we've done it before. So we've got the sold, the new, and the continuing. So the one I sold was half a year, so 40 grand times 20% times 6 months. So 20% of 40 is 8 grand. Multiply 8 grand by 6 months, or half, so that's 4 grand. The new one is 59 times 20% times 6 months. 55,900, and then the continuing. So the 90 had the beginning without the 40. Okay, means of the 90, 50 of it I had for the full year. So 50 grand times 20%. So that's 10 grand. Okay, so that is depreciation expense. and we're going to add that on to my accumulated depreciation. Okay, so I need to work out the vehicles. So that's the disposal depreciation. So it's profit or loss. So the thing originally cost 40. We take away the 28 grand depreciation, so it's actually worth 12. Okay, so it's 12 net book value. So the allowance was 9 grand. So I got a loss of 3. Okay, so my accumulated depreciation of vehicles then would be, sorry, I kind of digressed and I started working on that, but all I needed to know was the vehicles depreciation. The vehicles were 90 grand, multiplied by 20% a year, and multiplied by 3 years, so that's 60%. So that's the total depreciation figure. So actually, I just realized that number there is wrong. So that should be 54. So 3 years depreciation minus this year. So that means I just put an equal sign there. So this is what's going to go into my balance sheet. Okay, so back to this, and I'm sorry for digressing there, just in case that confused you. It just was something I wanted to get dealt with as we go through. So we've dealt with the fixed assets accumulated depreciation. We've done that. We've done our depreciation down there. We'll be able to put the depreciation figures, as we just worked them out. We'll be able to put those figures in later on into our profit and loss. Then we look and see we've got a balance at bank. And it's on the debit side, so that makes it an asset. Again, I'm reading down through this here. The investment income is 1200. We need to double check, did we receive enough? If not, we may need to have an investment income due. We'll come and deal with that later on in our profit and loss. Again, I'm looking for anything that's relevant for the beginning. So we had a €50,000 loan, and there's going to be loan interest on that as well. So loan and loan interest due. So loan, we're told 50 grand. Now we don't know the percentage of the interest. It was repaid for with 15 months interest. So that means there would be 3 months interest of this year and 12 months of last year. So the loan interest due, I'm just going to note that there for myself. It's going to be 12 months. Now the total figure for loan interest is 50 from 56 is 6 grand. So 6 grand, 12 15ths of the 6 grand is going to be due at the beginning. And then the remaining figure, I'm going to put them down to my expenditures. So loan interest is going to be 6 grand times 3 months. So 3/15 out of, times 3 divided by 15. So 3/15 out of the total of 15 months interest, 3 months of that is going to be used up during this year. Back up to the top. Okay. So that's the only other thing that I can see that is relevant for the start of the year. End of the year cleanings are on contract, so there's a payment for, so there's going to be prepayment for next year. Clients fees, and now remember we're doing 2013, so that's for 2014 is paid for next year. Fees due from clients at the end of the year, okay. Wage and salaries include 20 paid to the secretary who also runs the shop. 40% of this, so that's going to be a shop expense. Attributed to the shop. Electricities, again, I'm looking for anything that might be relevant for the beginning of the year. No. And they revalue the building, so there's nothing else. So that should at this stage be everything that I need for my statement of reserves, including our capital and everything. So that should be that will give us the reserves that we'll then put into the balance sheet.